Welcome to Section 4 of the ASC 710 training series. This section covers two special areas: sabbatical leave, which has unique accounting rules depending on whether it is earned by past or future service, and termination benefits, which are treated very differently depending on whether the separation is voluntary or involuntary. By the end of this section, you will be able to distinguish between a sabbatical for rest and recuperation and a sabbatical that serves the employer's benefit, determine when each type must be accrued, define special termination benefits, and identify the recognition trigger. Apply the 4 ASC 420 criteria required before recognizing an involuntary termination liability, and record the journal entries for both voluntary and involuntary termination benefits. Sabbatical leave is extended paid leave granted to an employee after completing a qualifying period of service. The accounting treatment depends entirely on one key question: does the sabbatical benefit the employee for past service rendered, or does it require the employee to continue contributing to the employer during the leave period? If the sabbatical is a reward for past service, it must be accrued over the qualifying period. If the employee is expected to deliver outputs or continue work during the sabbatical, the benefit flows to the employer, and the cost is expensed when the sabbatical occurs. The first type of sabbatical is a rest and recuperation sabbatical, where the employee is away from work with no duties or deliverables required. This sabbatical is earned through the qualifying years of service and benefits the employee rather than the employer during the leave period. Because the benefit is attributable to past service, it must be accrued over the qualifying period in a similar way to vacation leave. For example, if an employee earns a 6-month paid sabbatical after 7 years of service, 1/7 of the total cost should be accrued each year. The second type of sabbatical requires the employee to undertake research, deliver reports, or continue performing duties that benefit the employer during the leave period. Because the employer receives an ongoing benefit from the arrangement, the sabbatical is not purely attributable to past service. In this case, accrual over the qualifying period is not appropriate. Instead, the compensation cost is recognized as an expense when the sabbatical actually takes place. This distinction is critical and must be assessed based on the specific terms of each sabbatical arrangement. Termination benefits are compensation provided to employees in connection with the ending of their employment. A SC 710 and a SC 420 divide termination benefits into two fundamentally different categories. Voluntary termination benefits, also called special termination benefits, are offered by management as an incentive for employees to leave voluntarily. Involuntary termination benefits arise when management decides to lay off or restructure employees who did not choose to leave. The recognition timing for each category is determined by a different trigger, and applying the wrong standard is a common mistake. A special termination benefit is an offer made to employees for a limited period as an incentive to voluntarily separate from the company, such as an early retirement package or a voluntary severance program. The liability is recognized when the employee accepts the offer, and the amount can be reasonably estimated. This is an important timing distinction. Recognition occurs on acceptance, not when management announces the offer. Until an employee accepts, there is no obligation to recognize because the employee may decline and remain employed. When an employee accepts a voluntary termination offer, the journal entry is straightforward. Debit termination benefit expense and credit termination benefit payable for the amount of the agreed severance. This entry is recorded on the date of acceptance, not when the offer was initially announced. The liability remains on the balance sheet until the cash is paid to the departing employee, at which point the entry is debit termination, benefit payable, and credit cash. If the amount is uncertain at acceptance, accrue the best estimate, and adjust when the final amount is determined. When management decides to lay off employees as part of a restructuring or exit activity, the termination liability is recognized under a SC 420, not a SC 710. A SC 420 has a strict recognition requirement designed to prevent companies from creating restructuring reserves prematurely. All four SC 420 criteria must be satisfied before any liability is recorded. Recognizing a restructuring reserve before all four conditions are met is a common error that auditors specifically look for. The four ASC 420 criteria are as follows. First, management must have approved a termination plan that specifies the benefits to be provided. Second, the plan must identify the number of employees to be terminated, their job functions, and the locations affected. Third, the plan must be unlikely to change significantly before it is implemented. Fourth, the plan must have been communicated to the affected employees in enough detail for them to understand the type and amount of benefits they will receive. All four must be met simultaneously before a restructuring liability is recorded. Once all four ASC 420 criteria are satisfied, the journal entry is a debit to restructuring expense, typically labeled as restructuring expense severance, and a credit to restructuring liability. This entry should not be recorded earlier, even if management has approved the plan internally, because the communication to employees is a required condition. As individual severance payments are made, the liability is reduced with a debit to restructuring liability and a credit to cash. A roll forward of the restructuring liability by category is required in the financial statement disclosures. Let us review the key takeaways from this section. A sabbatical granted for rest and recuperation must be accrued over the qualifying service period. A sabbatical that requires the employee to perform duties for the employer's benefit is expensed when the sabbatical occurs. Voluntary termination benefits are recognized when the employee accepts the offer. Involuntary termination benefits under a SC 420 are recognized only when all four criteria are satisfied, most importantly when the plan has been communicated to employees. Recording a restructuring reserve before all four ASC 420 conditions are met is a common audit finding. Thank you for completing Section 4 on sabbatical and termination benefits.